Today we're going to talk about job order costing. It's chapter 4 in the textbook. And just a quick overview of what job order costing does. Job order costing is a way of measuring the cost of products. When a company produces many different products, each one with different unique features. So this would be a company that makes many different kinds of products every period. And usually the products are made to order. And the unique nature of each order requires training, tracing, or allocating the cost to each job and maintaining records for each job. So virtually everything that you make is unique, and you need to keep track of the cost of each item that you make or each lot of items that you make separately. So some typical companies that would use job order costing include Boeing, makes airplanes, Bechtel does large-scale construction, Hallmark makes greeting cards. In other words, each greeting card that they manufacture would be treated as a separate job. Another good example is diamond jewelry. Every item is unique, and so the cost of making it needs to be kept track of separately. Another one I use is yachts, yachts that go on the ocean. And typically, every yacht is custom built to its owner's specification, and therefore you need to keep track of the cost of it separately. So basically what we're doing is we're taking the costs that we have in the factory and distributing them, charging them to individual jobs. So for example, here we have 3 jobs that we're undertaking, and job 1, 2, and 3, whatever they are, think of them as yachts perhaps. And what we need to do is we need to determine how much materials, how much labor, and how much manufacturing overhead goes into each one. And it's important to know that it's not just about materials and labor, it's also about manufacturing overhead. And remember what manufacturing overhead is. Manufacturing overhead are indirect costs of producing goods that you can't necessarily trace to individual products, but you still need those costs in order to make the products. So for example, if you have a factory, the factory building is going to have depreciation, it's going to have utilities, it might have management, all sorts of costs like that, which you can't make the goods without it, but at the same time, it's hard to determine how much electricity goes into every unit that you make. So an important component of job order costing and really all kinds of manufacturing is going to be to find a way to allocate the cost of manufacturing overhead to even individual jobs, even though these costs can't be directly traced to those jobs. And that's a very tricky process, but it's extremely important when you're determining the cost of the goods that you're making. We have something called a job cost sheet, and this would simply keep track of how much direct materials, direct labor, and manufacturing overhead goes into each job. So as you can see here, we have a job number, a description, and then areas where you would indicate how much materials, how much labor, how much overhead, add it all up, and then perhaps figure out the cost per unit. A materials requisition form would be a form that you fill out every time that you use raw materials and you're going to apply it to a certain job. So in this particular form here that you see, a materials requisition form, you can see that we have 12 2x4s and 21 by 6s, and these are going to be placed into job A143. And it's signed by Bill E. Delight. And so this was $116, and this will be allocated over here. It's added in, direct materials, $116. For direct labor, each person as they work, here's I am skilled, will indicate what jobs they're working on. So for example, I am skilled on March 5th spent 8 hours from 8 a.m. to 4 p.m. working on job A143. So we would go into the job cost sheet and indicate that 8 hours were worked at a total cost of $88. And that way we would keep track of the direct labor rate and how much direct labor should be applied to this particular job. Learning objective 4-1, compute a predetermined overhead rate. And what we're going to need is we're going to need an allocation base. And the allocation base is basically going to be whatever it is we're going to use to allocate that overhead to the units. And as we said, this is difficult because overhead is not easily traced to individual items. So we have to find a way to do it, and we're just going to do it based on an allocation base. For example, direct labor hours, what we would say is that the more hours that someone works on something, the more overhead we're going to apply. The more hours someone works, the more overhead that unit gets. Or it could be direct labor dollars. The more we spend on labor working on this item, the more overhead it gets. Or machine hours. The more machine hours are needed to make this unit, the more overhead we're going to apply to the unit. And wherever the most machine hours go, that's where the most overhead is going to go. And so we would choose an allocation base in order to apply this manufacturing overhead to individual units. And we have no choice because it's impossible to trace these items individually. Manufacturing overhead consists of all kinds of different items that some of them are pretty expensive, some of them are not very expensive, but we need some way to allocate them to the goods because we can't produce the goods without them. And the reality is that a lot of overhead is fixed. So the more you produce, whether you produce a lot or a little, your overhead is still going to be the same. So it's very difficult to do this allocation, but at the same time, since you can't make the goods without the overhead, we need a way to determine how much overhead we incurred, how much overhead cost there was for each unit in order to determine how much those units are going to cost. And a key tool here is what's called a predetermined overhead rate. And the predetermined overhead rate is going to be a rate that we determine at the beginning of the period. And we're going to take the total overhead cost and divide by the number of units of allocation base. And then each unit of allocation base will get a certain amount of overhead. We'll just zap it with overhead. I'll give you an example in a moment. And this makes it much easier if we can determine what the allocation base is, how much of that allocation base is needed to make an item, then we can determine how much overhead it's going to get. And the book gives you 4 steps. I'll go through it. I don't quite use the 4 steps that they use, but I'll go through this with you. 1, estimate the total amount of the allocation base that will be required for next period's estimated level of production. Estimate total fixed manufacturing overhead costs for the coming period and variable manufacturing overhead costs per unit of the allocation base. Use a cost formula to estimate the total manufacturing overhead costs for the coming period, and then compute the predetermined overhead rate. So these are the steps, and we'll go through how to do this in just a moment. So learning objective 4-2 is to apply overhead costs to jobs using a predetermined overhead rate. And I provide the formula here in my notes just to show you estimated total manufacturing overhead costs. I'm going to use a few abbreviations in my notes, and these are kind of standard abbreviations. They make it easier to remember everything. Direct material is DM, direct labor is DL, and manufacturing overhead is MOH. So your 3 basic cost components are going to be DM, direct materials, DL, direct labor, and manufacturing overhead, MOH. And to determine the predetermined overhead rate, you're going to take the estimated total MOH at the beginning of the period and divide by the estimated total allocation base. And to help us do this, we can again use this formula of y equals a plus bx, where instead of looking at using this to measure the total cost, we're just going to use it to focus on overhead. So y is total manufacturing overhead, a is fixed manufacturing overhead, b is estimated variable overhead per unit, and X is the total number of units, in this case the number of units of allocation base. And then we're going to take the predetermined overhead rate, multiply it by the allocation base, how much of the allocation base is needed for a job, in order to get the overhead that gets applied to a specific job. And remember, our goal here is to take the total manufacturing overhead and apply it to all of the jobs, and to understand how much overhead cost goes into each job that we make. So let's take an example. The estimated direct labor hours needed for the year are 40,000. The estimated total fixed manufacturing overhead is 220,000. And estimated manufacturing overhead cost per direct labor hour is $2.50. So total manufacturing overhead cost should equal the $220,000, that's the fixed overhead, plus $250, that's variable overhead per unit, times the number of expected units is 40,000. And the estimated amount of the allocation base is 40,000. So this should be equal to, working it out, 220 plus 2.5 times 40,000 units divided by 40,000 units equals $8 per unit. And that's really the key figure here. And the unit here I should indicate is per DL hour. In other words, every direct labor hour that the company has, we're going to zap it with $8 worth of overhead. And that's all there is to this. It sounds complicated. It's really quite simple. So if we have a predetermined overhead rate of $8 a unit, and we have a total of number of direct labor hours is 27, then the total cost, the overhead allocated to this particular job, is going to be $8 times 27 hours. Or $216. So that means the overhead needed for this job would be $216. And you can see here what the job order card is going to look like. Here you can see materials, labor, and overhead would be $216. And if you add all this up at the bottom, the total product cost is $1,800. And they're making 2 units. Therefore, total product cost per unit is going to be $900. And that's how you do learning objective 4-3. Compute the total cost and average cost per unit of job. Now, it would help here to go through. Let's look at this job order cost sheet one more time. And you can see here materials and labor accumulated and then added up to a total cost here of $236. In this particular case, this is the case in the book, in the slides rather. So product cost would be $118. But let's go over the example that's in the book. First, let's look before we do that, first let's look at Exhibit 4.5, because I think this is instructive in seeing how costs behave. In that we have basically 4 classifications of cost. And this is big picture again. I went over this in the last 2 chapters, and I haven't seen it in this nice diagram, so I think it's worth taking a minute just to look closely at this. We basically have 4 kinds of costs. We have raw materials, or I'll call them direct materials, direct labor, and manufacturing overhead. And then I also have selling, and remember, I have selling and administrative costs. Materials, labor, and overhead are product manufacturing costs, whereas selling and administrative costs are what we call period costs. And remember the difference again, that period costs go into inventory and they become assets as part of your inventory. When you sell your inventory, they become cost of goods sold. Whereas period costs, like selling and administrative costs, go straight to the income statement. They're expenses as soon as you have them. So product costs become your inventory and they're assets until you sell them. Period costs are expenses. They go right to the income statement. Now, how do materials, labor, and overhead go to the balance sheet? Well, when you buy materials, that becomes your raw materials inventory. And you take those raw materials and you put them onto the assembly line. Everything on the assembly line is work in process. That means that you're working on these items and they've started, but they're not yet finished. Those are the items on the assembly line. So on the assembly line, that's where everything comes together. Your raw materials, your direct labor, and your manufacturing overhead are all put together. People work on the materials while the lights are on, that's your manufacturing overhead, in order to finish the goods. And when they're finished, they become what's called finished goods inventory. That's an asset. When you sell that inventory, it becomes cost of goods sold and it hits the income statement. So the really nice thing about this exhibit 4-5 is it really summarizes how the costs work. And what we're trying to do here is we're going to really focus in this chapter on understanding how manufacturing overhead can be applied to work in process inventory, and then how these costs flow into cost of goods manufactured and cost of goods sold. I'm quite proud of how beautiful this is. I've spent some time on it and I made it like slightly different colors, so it kind of, I don't know, maybe we have two jobs here that we're allocating costs to. Job A and Job B. And Job A is on the assembly line. We've already spent $30,000 on it. Job B, brand new job. We haven't spent anything on it yet. And there's also a section here for manufacturing overhead costs, and we'll fill that in. So what we're going to do here is, the first thing that happens is we need materials. So we fill out something called a materials requisition form, and we need $28,000 worth of materials for Job A, $22,000 for Job B, and also indirect materials, think of it as glue, for $2,000. And when we put them into production, an accountant somewhere, someplace, is going to add them to these job cost sheets. So you've got another $28,000 in direct materials here. I should make this red. And you've got $22,000 in direct materials going here. And you've got $2,000 in indirect materials going here. So the goods go into production and the costs get added to the job cost sheets. Next, people do work. And Job A accumulates $40,000 in labor. Job B accumulates $20,000 in direct labor. And we also happen to have $15,000 in indirect labor. And by definition, indirect labor is part of manufacturing overhead. We don't know how much labor goes into the units. That's just people working. So we have here $40,000 going to Job A, and $20,000 going to Job B, and $15,000 that's indirect. And we don't really know where it's going, but we know it's there and it's necessary. So these will also get added to your job cost sheets. And we're accumulating this manufacturing overhead as we spend money on these things. And then we have additional manufacturing overhead of $78,000. And this is all sorts of things, rent, management, and so on. Electricity, utilities, property taxes. So that just gets added into manufacturing overhead incurred. So there we are. Now you might think we're going to take manufacturing overhead incurred and spread it out into Job A and B. And that's not how we do it at all. Because we need to it's called a predetermined overhead rate for a reason. It's called a predetermined overhead rate because we already determined it before the period began. And we can't wait until the end of the period to know what it is. We need to know it at the beginning of the period so we know how much overhead we're going to zap each unit with. So here we could see we have job A and job B. It's $6 per machine hour. So job A had 10,000 machine hours. Job B had 5,000 machine hours. We taxed them each at $6. And therefore, job A is going to get zapped with $60,000 in overhead, what we call overhead applied. And job B is going to have applied to it $30,000 in overhead. So now what happens? Let's apply job A. Job A is going to be 60,000, and that will give us a total of 158,000 in overhead. Job B is going to have 30,000, giving us $72,000 worth of overhead. And manufacturing overhead incurred, meanwhile, was $95,000. We know that before. 2,000 plus 15,000 plus 78,000 comes to 95. It's very interesting because manufacturing overhead is $95,000, but I only applied 90,000 because that was what happened based on my allocation rates. So let's look at the calculation there for just a moment. The calculation was that manufacturing overhead incurred was 95,000, but manufacturing overhead applied was only 90,000 because the 90,000 was based on what the predetermined overhead rate, and that's not necessarily what happened. It was based on estimated cost and estimated allocation base, and then reality kicked in and actual overhead was $5,000 higher. So we have what we call manufacturing overhead underapplied. We had an additional $5,000 in cost here, which we're going to have to do something with. So there's two things that you can do with overhead under or over applied. And again, if it's under applied, that would mean that you had additional cost and you need to record higher expenses. If it's over applied, that means you recorded more overhead than you actually had, and therefore you would have less expenses. If it's small, it goes to cost of goods sold. If it's large, then it's going to get allocated between work in process, finished goods, and cost of goods sold. And the book doesn't even mention option 2. It's here in the slides, but it's not in the book. But you would allocate them to work in process, finished goods, and cost of goods sold in proportion to the balances in those accounts. It says in proportion to overhead applied during the current period that is in the ending. I guess what they're saying there is a little bit better. This number 2 would only be done if it was really large. Usually what you're going to do is number 1 if it's relatively small, and you came pretty close but you didn't quite make it. So if it's over applied, it'll be deductive just from cost of goods sold. Under applied, added to cost of goods sold. Every example in this class is going to go straight to cost of goods sold. Here's an example of overhead of setting a predetermined overhead rate, allocating it to units, and then over and under applied. So we have two companies here, and this is from the book, obviously, Turbo Crafters in black and Wang. And Turbo Crafters, we'll do them one at a time, has estimated manufacturing overhead at the beginning of the period of 300,000 and a total allocation base of 75,000. So that would be predetermined overhead rate of $4 per machine hour. $4 per machine hour. And direct material cost is 120 divided by 80, or 150% of direct material cost. So with turbocrafters, every machine hour that is needed to make the unit is also going to bring with it $4 worth of overhead. So the actual overhead is $290,000. And the actual allocation base, the machine was running 68,000 machine hours. So if your predetermined overhead rate was $4, then you would be applying a total of $272,000 worth of overhead. Because every hour gets $4, you had 68,000 machine hours. Therefore, total overhead that would be recorded and applied to individual jobs would be $272,000. But your actual overhead was $290,000. So you would be short, you're under applying your overhead by $18,000 because you're only applying $272,000, but the actual overhead was $290,000. Why was there a difference? Well, look, you were planning on $300,000 for 75,000 machine hours. You actually only had $290,000, and your machines were only running 68,000 machine hours. So things did not quite work out the way you planned, but that's reality. Sometimes things don't work out the way you planned. Anyway, let's look at Black and Wang for a moment. Black and Wang decided that they're going to apply overhead based on direct material cost, and overhead is 150% of direct material costs. And it's interesting that it's more than 100%, because that would mean that you're actually applying more overhead than you have the allocation base itself. It's more than 100%, but this happens all the time. So actual allocation base was $90,000, and we're going to zap it at 150%. So that means we're going to apply to this $135,000 worth of manufacturing overhead to the units produced. And the actual overhead was only $130,000. So that would mean that we are over applying overhead because we applied $135,000 even though the actual overhead was only $130,000. And therefore we would have over applied of $5,000. So under applied overhead would be added to cost of goods sold, and over applied overhead would be subtracted from cost of goods sold. So now we're going to do learning objective 4-5, use the direct method to determine cost of goods sold. And this is very simple. You calculate cost of goods sold and you adjust it for any overhead under or over applied. So let's go to the cost of goods sold direct template. And I'm going to abbreviate cost of goods sold, COGS, just for simplicity's sake. And cost of goods sold is how much it costs to produce or purchase the goods that you sell. So to use the direct method, you would simply add up what the cost of goods sold is. So here we had a job cost sheet, and we figured out, we started with $30,000, we added direct materials, direct labor, and manufacturing overhead, and we got a total cost of $158,000. Now it just happens to be that we produced 1,000 units. So that would mean that the cost per unit would be $158 per unit. That's how much it costs to make them. We sold 750 units. So 750 times 158 would be 18,500. That's cost of goods sold before any adjustment for under applied. Then we add in the additional overhead that was under applied, and we get an adjusted cost of goods sold of $123,500. So you would simply add up the direct materials, direct labor, and manufacturing overhead, and then adjust for any cost of goods sold, any overhead under or over applied, and then you would get adjusted cost of goods sold. Learning objective 4-6, use the indirect method to determine cost of goods sold. Let's start off again with Exhibit 4-5, and you can see the flow of goods. We're going to need to calculate cost of goods manufactured. That's the cost of goods that go from work in process inventory to finished goods inventory. And then finished goods inventory that actually gets sold, that would be valued at cost of goods sold and shown on the income statement. So to calculate this cost of goods manufactured, I'm going to use some more abbreviations. I hope you know mine. So far we have DM, direct materials, DL, direct labor, MOH, manufacturing overhead, cost of goods sold, COGS, and now I'm introducing two more, WIP, WIP, work in process, and FG, finished goods. So total manufacturing costs charged to jobs plus beginning work in process minus ending work in process is cost of goods manufactured. And then cost of goods manufactured plus beginning finished goods inventory minus ending finished goods inventory equals cost of goods sold. I'm going to reorder that. There you go. So these are basic formulas. These are formulas to know. And let's look at some numbers and plug all this in. So we're beginning work in process at $30,000. Total manufacturing costs for two jobs, job A and job B, have direct materials, direct labor, and manufacturing overhead applied. Total cost was $200,000, manufacturing costs. Ending work in process was $72,000. And these are all the costs of job A, which was actually sold. Job B was not sold. And we have underapplied overhead of $5,000. The same example that we were looking at before. So the manufacturing costs that were charged to jobs were materials of $50,000, labor of $60,000, and manufacturing overhead of $90,000. So total manufacturing costs charged to jobs would be $200,000. And then we add beginning work in process and subtract to get 230. You know, I'm going to write my totals in bold so they're more. And then I'm going to subtract ending work in process of $72,000 to get cost of goods manufactured of $158,000. Now I'm going to use that to calculate cost of goods sold. So my beginning finished goods inventory is, it's here someplace. Zero. I'm going to add cost of goods manufactured from here, and that will give me goods available for sale. I'm going to subtract ending finished goods inventory. That would be 250 units in ending inventory at a value of $158. I'm sorry, I should break it down. 250 units worth $158. So the total cost of ending finished goods inventory is $39,500. That's going to be deducted, giving you unadjusted cost of goods sold, because I haven't yet adjusted it for over applied. I have under applied of $5,000, and therefore cost of goods sold would be $123,500. Now I have my selling and general administrative expenses here are just given. So for my income statement, this should say income statement. Sales is given as $225. Cost of goods sold is $123,500. So sales minus cost of goods sold is equal to gross margin or gross profit of $101,500. Selling and administrative is given to me. So net operating income would be $14,500. And that's your income statement. So everything will come together here on the income statement when we calculate cost of goods sold. This is how we determined how much the goods cost, because we combine the direct materials, direct labor, and overhead. And the real trick here was how to allocate the overhead. We do it based on the predetermined overhead rate, but it may need to be adjusted for overhead under or over allocated.